Hi friends, so let's now move to chapter 13 for theory discussion, which is on business valuation. Just to give a broad overview of the chapter, what we are covering in business valuation is what are the traditional methods of doing valuation. Then we are also discussing how do you value a going concern, how do you value a non-going concern, and then move on to specifics like distressed company valuation, startup valuation, professional companies or consultancy firms valuation. How do you consider the impact of ESG on valuation? So let's start with the first question, which is on various approaches for valuation. These are basically the traditional approaches of valuation. That is what we are doing in valuation is we are trying to arrive at a fair value for a company or a business. Objective is to arrive at a fair value for a company or business. Broadly, we can categorize these approaches into four. One is asset-based valuation. Second is earning based valuation, cash flow based valuation, and we also have a relative valuation approach. So these are the four type of approaches we discuss. Asset based valuation is going by the balance sheet of the company. You have the balance sheet of the company, take various assets, deduct the liabilities, you will get the value of the firm. In this, you may sometimes adjust the asset figure, sometimes you may not adjust the asset figure. That is where the variant comes. The value of the shares of a target company is computed in terms of net assets acquired. And now, what you do is, one is net realizable value. Here, you are basically valuing the asset on the basis of liquidation value, replaceable value on the basis of replacement cost, and net asset value approach. Net asset value approach, you go on the basis of historical cost, but make certain adjustments if needed. There can be certain adjustments which the question can give. You can make those adjustments and value the entity. Asset-based valuation approach is basically based on the assets of the company. There are multiple businesses where the balance sheet may not have a lot of tangible assets. There are a lot of intangible benefits which are there on the company. The brand strength is there that may not get reflected in the balance sheet. In such scenario, asset-based valuation approach may not be feasible. If you have a lot of intangible benefits, then asset-based valuation model is not the right approach. The other one is earning-based model, where we are valuing the company on the basis of future earnings of the company. What is important is based on the future earnings of the company. Assumption is I am going to acquire an entity and continue that company for a longer period. I am not going to sell or liquidate the assets of the same. I plan to continue. Two approaches. One, you can take PAT into P multiple. Inverse of P multiple is called earning yield. When you do 1 by P multiple, it can be called as earning yield of a company. What is earning yield is? Earning yield formula is EPS by MPS. And P multiple is MPS divided by EPS. Or the other approach is capitalization of earning method, where you take the future maintainable profit and divide by a capitalization rate. Then is a cash flow based model. Under cash flow based model, I have an FCFF approach or an FCFE approach. That is, you arrive at the free cash that is available, discount it at the appropriate rate. If you are using free cash flow to the firm, you will discount it at cost of capital. And if you have free cash flow to equity shareholders, you will discount it at cost of equity. Another model which is also there, which is not covered in the approaches for valuation, but that also can be discussed. I'm going to anyway discuss it later, I think in question 4 or 5, called as relative approach of valuation, where we value the entity based on others in the industry or based on averages of the industry. I'll discuss as we proceed. Explain how cash flow based approach of valuation is different from income based approach of valuation. Major difference is very simple. In income based approach, I go with PAT or profit which is getting generated by the company, whereas in a cash flow based approach, we are looking at the free cash flow which is available with the firm after meeting all its requirements like working capital, capital expenditure. After meeting all of this, you identify how much is the quantum of free cash that is available. As a company becomes matured is there is no major growth happening in the company. You have reached a maturity stage. You have an introduction stage, growth stage, maturity stage. As you reach a maturity stage, a lot of companies profit after tax and cash flow after tax will start matching. So these two approaches can coincide at some point of time, but most of the times it will be different. Now, whatever cash flows you have got, you will have to discount them at either cost of capital or cost of equity and arrive at value of firm or value of equity. So the steps we are doing is we'll first arrive at the cash flows, get the future cash flows, discount them, get the terminal value. Terminal value is valuation of a perpetuity, and arrive at the value of the entity. This is on the cash flow based approach. What are steps in valuation of unlisted companies? Now, listed companies, because it is in the marketplace, I can do comparison easily with others in the industry, or I also can get a market value for that entity. For an unlisted company, we do not have market value. So how do we go about valuing an unlisted company? For valuing an unlisted company, assume you want to value an IT company. So first thing you need to do is take the average beta of the industry. Take the average beta of the industry. You can go through the market. If you want an IT company, there are 30-40 IT listed players out there. Take the average beta of that. Once you take this industry beta, you will have to convert the levered beta into unlevered beta. How do you convert? You learn this in portfolio management chapter. You have to convert this levered beta into an unlevered beta. Using the unlevered beta, you will get cost of equity. Using the unlevered beta, so you can use unlevered beta. Use unlevered beta and get cost of equity. There's a formula for converting levered beta into unlevered beta, but it is better to do it in the table approach which we do in portfolio management chapter. So use unlevered beta and get cost of equity, get cost of debt, compute WACC. This will be the discount rate for doing the calculation. So I have the average beta of the industry. You want to value in any IT company, you can do this in a practical world. Take the average beta, convert the levered into unlevered beta, get cost of equity, get cost of debt, get the WACC. Apart from this, because it's an unlisted company, the financial statements may need to have certain adjustments because maybe the accounting policies are not properly followed. Because a listed player, because there is a lot of people who are interested in their financial statements, lot of stakeholders are there, most of the policies could be properly followed, but in an unlisted company, that the financial statements can have certain gaps. So you will have to adjust all these gaps which are there and get the cash flows, discount the cash flows at WACC, get value of firm. Also add something called as a return for goodwill. You can add something called as a return for goodwill, that is give something extra to the promoters when you are trying to acquire. So present value of future cash flows plus the goodwill payment can become the value of the firm. That is what you do for an unlisted company. Relative valuation method, practically most important method of valuation. In fact, the three methods which we saw, that is your asset based valuation, earnings capitalization method, or you saw something called as your cash flow based. You can arrive at a value of under each of the method, but in order to validate that answer, whether what we have done is right or wrong, that validation can come through relative valuation model. Under relative valuation model, it is also called as valuation by multiples. What is valuation by multiple is you take industry averages. I want to value my entity. I want to know what is industry EV to EBITDA multiple. Then my value is equal to average industry multiple into EBITDA of my company. I want to do average P multiple multiply with PAT of my company. Average market value to book value multiple multiply with my book value. Is a method used at arriving relative value using a comparative analysis to the peers or similar enterprises. This is also known as valuation by multiple, and as I said, a lot of people are using this to validate the value which you have arrived. You will try to validate or check whether whatever value you have arrived earlier, is that the right value or not. That validation can happen through a relative valuation method. So for doing this, you will have to find out what is the appropriate driver, get the financial ratios for that, and then get the value of the firm. Different industries can have different drivers. For example, Bharadwaj Institute, the driver can be number of students. IT company can be number of employees. This is just one driver. There can be multiple other drivers also. Understand the driver and then try to do the valuation of the entity. Explain chop shop method of valuation. We have seen this in problem solving also. Chop shop method of valuation is basically used when you have multiple segments or when you belong to multiple industries. So multi-industry companies, if you are belonging to multi-industry companies, you can break down your values into multiple segments and do valuation of each segment separately. So there can be a segment 1, segment 2 and segment 3. Segment 1 can be valued through capitalization by sales. Segment 2 can also be used same multiple as some other multiple. So every segment is separately valued in chop shop method, and you put a sum of those values. This approach attempts to identify multi-industry company that are undervalued and would have been more valued if separated from each other. That is, when you break it down into multiple segments, it is possible to value them, and you arrive at based on average capitalization rate and average, take the average values you have identified. You can use multiple approaches of valuation and then arrive at a final value. That's called value of the firm. Differentiate between economic value added and market value added. Economic value added is basically the excess return generated by a company after meeting the expectation of providers of capital. Whoever is providing capital, they need a return called as cost of capital. So you first meet the cost of capital, and after, along with that, or in excess of that, if you're generating, that's called economic value added, which can be positive or negative. We had a formula which is EBIT into 1 minus tax rate minus capital employed into WACC. There are a lot of adjustments which can happen on economic value added. We have seen this in problem. So EBIT into 1 minus tax rate minus invested capital into WACC. What is market value added is? Market value added is the excess value given to a firm as compared to its book value. Any organization which is generating positive EVA will also have a positive market value added, because you are generating more than what is needed. Market would be interested in giving a better value for such entities. So market may be valuing such entities at a higher value because you are having positive generation of EVA. So MVA approach is very simple. MVA is the current market value of the firm minus the invested capital. In simple words, as you generate EVA, your MVA will keep going up. How to value a company which is not a going concern? Very important thing. When you are not a going concern, because whatever companies we do valuation, we normally do a perpetuity valuation. Because we assume that there is unlimited life. You will value an entity for 1, 2, 3 and you will say 4 to infinity. This is valued as perpetuity. V3 is equal to FCFF4 by KO minus G. But if you are not a going concern, the important issue is that if you are not a going concern, this concept of perpetuity valuation will not exist, because you do not have infinite life. When you are having infinite life, all this is fine. But infinite life may not exist for a company which is not a going concern. So for a company which is not a going concern, our preferred approach is liquidation value approach. What is liquidation values? If you sell all your assets today, what value are you going to arrive? Non-going concern valuation is also known as liquidation value, because it's the net value realized after disposing of all the assets and discharging all the liability. Normally your going concern value will be greater than the liquidation value, because under going concern you are considering the future profitability. Also, whenever you are doing a liquidation value, there is always a distrust among the market for this company. Market is not feeling this to be a good company. There is a bad reputation which has been created. When a bad reputation gets created among the investors and the employees, naturally the value will get impacted. Now, this not a going concern, a classic example is a distressed company. A distressed company is one which is going through certain financial difficulties. Why conventional methods cannot be used for valuation of distressed company? A distressed company is one which is going through some financial difficulties. It could be because of operating leverage, that is, if you have fixed cost, if you have high fixed cost, or it could be because of financial leverage, which is if you have high interest cost. So you are not in a position to meet your financial obligation due to high fixed cost, illiquid assets, or economic downturns. All these are operational distress which has happened. Also, there can be a financial distress which can happen, because of which you are defaulting on your debt instrument. Now, such entities, if I am doing valuation, the conventional methods are going to fail. What are the conventional methods? The 4 methods which I said: the cash flow based method, the asset based method, the earnings based method, and also your related company valuation. So some of these methods would be used for valuation, but most of these are going to fail. Cash flow based method indirectly assumes infinite life. Discounted cash flow valuation method has an assumption of infinite life and ever growing cash flows. Because you are looking at infinite life, if you are a distressed company, that infinite life assumption may not hold good. So that is a challenge for applying the cash flow based method. Earnings based method, because most of them are having negative and declining revenues, negative profits, it is impossible for me to do a valuation under your earnings capitalization method. So what normally can be used is your asset based valuation, where you will do a liquidation based approach. That is the method we may use it. So also, when you are doing a valuation of a distressed company, you have to adjust the cash flow, also adjust the discount rate. What is discount rate? Is the cost of capital which we are using, because the discount rate normally uses for a financially strong company. When you are having a lot of failure possibility, the discount rate will significantly go up. In our theory, in our problem solving, you would have seen there are multiple methods of doing a distressed company valuation. We have seen problems on that. Modified discounted cash flow based approaches there, are a DCF valuation plus liquidation value, are an adjusted present value approach, are relative valuation approach. There are multiple methods of doing valuation. I'm not discussing them again. Next, why traditional method cannot be used for valuation of startup? Again, most of our discussion is going to be whatever we learned in traditional method will not be useful for a distressed company, will not be used for a startup, because unique characteristic. Distressed company, going concern is not there. Startup, the problem with the startup is most of the time startup does not have an established business as of now. It is not making money, it is making losses. In fact, it has a cash burn. What is a cash burn? Is it is burning cash every month. There is a cash burn which is happening. Normally you assume that there is going to be an established business. When you have an established business, you can do a valuation using your traditional methods. But for a startup, income approach will not help, because under income approach, I need company to generate profits or cash flow. Here, they are not going to generate profits or cash flow. Income approach and cash flow approach can be used as proxy. Many a times I use them to, I explain them interchangeably, but I cannot use them because most of the startup are okay with losses. Of late, this business model has been accepted and normalized by the investor community. Most of them are okay with startup making losses. Asset approach will not work because most of the value of the startup comes from intangibles. The valuation of Swiggy is not because of the physical assets which are there. The valuation of the Swiggy is because of the app which has been developed by them, which is more of intangible in nature. So a lot of valuation comes from intangible assets. So because of that, doing asset based valuation may not work. Market approach also will not work, because for market approach, what is market approach? Is relative valuation approach. I want certain proxy companies. I want a comparable company to do the valuation. Startup by nature is trying to work on a unique problem. When you are trying to solve a unique problem in the industry, you may not find a comparable company for the startup. So new age startups are disruptors. They generally function in a market without established competitor. So when you don't have established competitor, you will not be in a position to do valuation under the market approach or relative valuation approach. What are the value drivers for a startup? This is very critical. Where does the startup get its value from? The first thing is product or the service which is being given by the startup. Basically, the product or the service is the most important factor which will impact the value of a startup. Example, Swiggy's valuation. They were trying to tackle an issue in the market, that is connecting the customer with various restaurants in a seamless manner. That was the uniqueness of their business model, and that has led to good valuation for them. Management is another critical factor which impacts the valuation, because whatever idea you have, the execution of that will be brought in by the management. And here they are saying More than half of Indian unicorn startups have founders from IIT or IIM. Basically, people from these elite colleges have been able to execute their projects well, and because of which they have got a unicorn valuation more than $1 billion US. Traction means, are you generating revenues from it? Is quantifiable evidence that the product or service works and there is a demand for it. Revenue, how many revenue streams we are having. Industry attractiveness, that is in the industry, looking at the competition angle, looking at the other people who are there, how attractive is the industry, that also plays a vital role in the valuation of a company. Demand supply gap, if there is a demand supply gap which is there, that is if the industry is attractive, a lot of demand will come from the investors to buy companies. Also, the demand supply gap for the product is also very critical, because that is also going to indirectly impact the value of the entity. Competitiveness is how much competition is there in the market. You can somewhere look at this industry attractiveness, competitiveness from Porter's 5 forces model point of view, because whatever is there in Porter's 5 forces model is indirectly going to come here to understand the attractiveness of the industry. What are the different methods for valuation of startup? I think 6 methods are there. We have done problems on each of the method. I'll quickly discuss them. Berkus approach. This was by a venture capitalist called Berkus. He said that value of any startup is through 5 parameters: basic value, technology, execution, strategic relationship, and production and consequent sales. These are the 5 parameters. He in fact gave a value of $500,000, that is 5 lakh for each of these parameters. Every parameter I'll give a valuation of $5 lakh, and if a company is under pre-revenue means revenue is not earned. If you are yet to earn revenues, then the 5th factor does not exist: production and consequent sales. So you have only 4 factors for a pre-revenue company and 5 factors for a post-revenue company. Every factor $500,000. So if you are pre-revenue, maximum value is $2 million, and if you are a post-revenue, maximum value is $2.5 million. This is the maximum value. You can give a lower value on each of the parameter. Cost to duplicate approaches. Basically, the value of the startup is equal to all cost and expenses incurred to establish a startup, to establish a product, to do a marketing, to establish a service. Whatever cost we have incurred, if it's a software, the cost incurred to do coding, all of this will form part of the value of the startup. This is not a good approach because it does not consider the future earning potential. All cost and expenses associated with the startup and its product development. This is not focusing on the future revenue projections. Comparable transactions method is basically arriving at a value of a startup based on comparable companies or relative valuation. That is, some transactions could have happened in the industry. So look at comparable transaction. For example, if you bring in a software which is similar to an application which is similar to WhatsApp, so you can do the valuation of that software based on what value was given to WhatsApp. So you can do that because that was a transaction which happened some time back. So valuation of similar startups in the past. Scorecard valuation and Berkus approach is more or less related model, but under scorecard valuation, you are comparing your entity with someone in the industry or the industry averages and give a score on every parameter. You are trying to give a score on every parameter. The parameters could be similar to those Berkus approach 5, which were your execution part, or the product or the service part, or the strategic relationship, or the product and consequence sales. So strength of the team, size of the opportunity, product, competitive environment, marketing, need for additional investment. For each of this parameter, there will be a weight and there will be a score. You give a weight and a score on each of these parameters. Based on the weights and score, you will arrive at an average valuation. And then arrive at the valuation of a startup. You can look at that problem which we did in the class. You'll understand it better. First, Chicago method. This method basically said, let's consider 3 different scenarios. What are the 3 different scenarios? Best case, normal case, worst case. For each of the scenario, do a cash flow based valuation. Best case, what is the value? Normal case, what is the value? Worst case, what is the value? And do a weighted average. Valuation is done with the probability factor to arrive at a weighted average value. Venture capital method. A venture capitalist is a person who is investing in a lot of startup. He is called as an early stage investor. These guys, when they invest in a startup, they will have in their mind saying something called as an exit value. What value do I need at the exit? So they'll arrive at an exit value. This exit value needs to be discounted to today's value to arrive at the fair value of a startup. Estimating the startup's future value at the point of an exit event, based on the exit value, you arrive at the value today. Valuation of digital platform. Next is approach for valuation of digital platform. Approach is going to remain what we seen earlier. But let's first understand what is a digital platform. A digital platform is basically a software-based online infrastructure which is facilitating interaction between two parties. Example, marketplace. What is a marketplace? Is Amazon is a marketplace which is allowing an interaction between a customer and a seller. Google search. Google, where you are doing search engine. A search engine is basically allowing an interaction between us and we are doing a search and trying to identify some information. So marketplace, search engine, data repository, digital communication, WhatsApp, digital community, payments platform. These are some of the services provided by digital platform. How do you value them? Income-based approach or cash flow-based approach, relative valuation approach, or your cost to duplicate approach or cost approach. In income approach, what your ICA study material says is you have to first estimate the income of the digital platform. For that, you have two approaches of identifying the income. One is called a top-down approach and second is called a bottom-up approach. Basically, to calculate the income or the cash flows, whatever you call. To arrive at that, you have a total top-down approach and a bottom-up approach. What is top-down approaches? Understand the industry size, total addressable market. From that, find out what is our share. That is called top-down approach. Bottom-up approach is you know the resources which you have. What is resources is mostly men and money. The employees available and money available. Based on the resources, you decide how much revenue or cash flow you can earn. Based on the resources, how much revenue or cash flow can be earned. Arrive at that number. One is your total addressable market approach, top-down approach or a bottom-up approach. Based on the top-down approach or a bottom-up approach, arrive at the valuation which is feasible. Once the valuation is done, once the value is arrived at, once you arrived at the fair value of the, that is the revenues is arrived at, from the revenues, get the cash flows. If it's FCFF, discounted cost of capital, FCFE, discounted cost of equity, profit itself, then multiply with the P multiple or the capitalization factor. So based on either of the approach, you estimate the future earnings. WACC or cost of equity can be used to do the discounting part. Market approaches valuation based on proxy company or the others in the industry. Drawing a comparison with similar valued companies based on multiples like P ratio, enterprise value. These are financial ratios. You can also do valuation based on number of bookings, number of registered users, volume of transaction, number of active subscriber. You'll basically arrive at value per booking made or value per transaction of proxy company and arrive at value of our entity. Cost approaches, cost to duplicate. Estimate the value by calculating the total cost, focusing on the code written by the developer. All cost incurred is considered. This does not consider the future revenue potential and hence this is not a very good method of doing valuation. Special consideration in valuation of professional or consultancy firm. What is valuation of professional or consultancy firm? Is a professional firm is an example, firm of chartered accountants, firm of lawyers, or firm of management consultants which are providing services, unique services to its clients. When you do valuation of them, the approach remains the same. Either go with cash flow based valuation or you go with earnings based valuation and arrive at a value of the entity. So approach, nothing much changes. You will have to arrive at the value of the entity based on the cash flows and other things. When you are doing your cash flow calculation, you will have to take care that in case certain unique items are there. In addition to the analysis of financial statement and the comparison, normalization of net income and cash flow is another important aspect. This step involves adding back of non-cash items and specific items which might not apply to a new firm. So you'll have to do certain adjustments to the values. Once those adjustments to the cash flows or earnings is done, arrive at the value. This value needs to be adjusted based on key performance indicator. What is a key performance indicator? Some which can be used to measure the performance of a professional firm. For example, Bharadwaj Institute. KPI for Bharadwaj Institute can be student satisfaction rating, examination pass rates, number of students from inter who are ready to continue with us at final. So these are basic some of the factors which can be called as KPI. If you are performing better on a KPI, valuation of that entity will go up. And if you are performing weaker on a KPI, the valuation of the entity will go down. One commonly used method to analyze the impact is firm meets expectation in comparison to current industry benchmark and KPI. Since professional firms include several different types of firm, KPI can vary greatly, and hence it's equally important to look at indicators which align with acquirer's firm goal. Last question is impact of ESG on valuation. ESG is a framework which is significantly growing in the marketplace. There's a lot of focus which is there on ESG. ESG is environmental, social and governance framework. It is in fact similar to, in SEMP you learn something called as TBL, triple bottom line, otherwise called as 3P, people, planet and profit. For an organization to have a sustainable growth, sustainable is continue for a longer period, it is essential for them to focus on people, planet and profit. People is taking care of employees, taking care of customers, taking care of others. So people is basically in ESG framework called social. Planet is called environmental. Profit does not come in the ESG framework. Profit is the final result which you generate. There's something called as governance. What is governance? Is the corporate governance standards. How are you managing the company? Are you doing things ethically or not? So environmental, social and governance framework is something which is impacting a lot of decisions being taken by the company. Many companies voluntarily are complying with ESG framework. Earlier, ESG was something like an optional choice. Now it is like a must to have kind of a situation. Lot of big corporates, when you read their annual report, may have some commentary on the ESG side, environmental, social and governance. Now why it is critical to have an understanding of this when you do your valuation? Because this can impact your cash flow, can also impact the discount rate. Both can get impacted because of ESG. Is a framework designed to be embedded into an organization strategy that considers the needs and ways for all organizational stakeholders. ESG is a growing concern for investors focusing on environmental, social and governance aspect. Key environmental concerns include climate change, natural resource scarcity, diversity, cyber security. ESG is also having an impact on funding sources. In practical world, you have something called as green bonds, social bonds, sustainability linked bonds, ESG bonds. So these companies which are ESG compliant, if you are ESG compliant, you will be able to raise money from green bonds or social bonds, which will have normally lower interest rate. High ESG focus from investors, lenders led to preferential debt cost. Preferential is lower debt cost. ESG is now considered to be a must-have. Earlier, it was not a must-have kind of a situation. Now it is more like mandatory for organizations to comply with ESG, all the bigger corporates. So environment is taking care of the environment part, social is taking care of the people, employees, all of them. Governance is basically following all your business ethics properly. When you have minority shareholder, you should not cheat minority shareholder. Doing all meetings properly. No internal disclosure of that is no insider trading. All that should not happen in an entity. You should ensure that all the corporate governance standards are properly done. The ESG factors can be incorporated in future cash flow or the discount rates. What we normally try to do is adjust on the cash flow side rather than the discount rate side. That is the preferred approach, but either of the approach can be followed. So I'll just summarize what we did in valuation. We initially started with various approaches of valuation, where you have an asset-based valuation, which is net asset method or a net realizable value method or a replaceable value. Earning-based method, which is P multiple or capitalization of earning method. Cash flow-based method, where you have FCFF or FCFE. How is cash flow different from earnings? In earnings, we work with PAT. In cash flow, we are working with cash flow free cash flow available after meeting your capital expenditure, after meeting your working capital requirement. How do you do valuation of an unlisted company? Get the industry beta, take the average industry beta, convert the unlevered into levered beta. Sorry, convert the levered into the unlevered beta. Sorry, what did I write here? Yeah, convert the levered beta into the unlevered beta. After doing that conversion, get the cost of equity, get the cost of debt, get WSCC, do the valuation, and give some valuation for goodwill which can be there. Relative valuation is valuation by multiple. You are arriving at the average multiples in the industry and then arriving at the valuation for your entity based on that. Chop shop method is useful in case you have multiple segments or multi-industry company. Different segments could be valued differently using, some could be on capitalization by sales, some could be on capitalization by EBITDA. Basically, you're breaking down the valuation and then clubbing all the three values together. 3, 4, 5, 6 based on number of segments. EVA is the excess return generated after meeting the expectation of the providers of capital. MVA is the excess value of firm as compared to the book value of firm. How to value a company which is not a going concern? In case you are not a going concern, then you have to go through something called as a liquidation valuation approach. You will value the entity based on liquidation value, which is basically by selling all the assets and settling off all the liabilities. The liquidation value will be lower than the going concern value because one, there's a bad reputation. Second, there are no future profits which are getting generated. Why conventional method cannot be used for distressed company? Cash flow method cannot be used because you are not going to continue for a longer period because infinite life is not there. Cash flow method assumes infinite life. Earnings method is not possible because under earnings method, the problem for me is there are no profits which are being generated. Also, the discount rate which you do for calculation needs to be adjusted significantly to take care of the risk of the bankruptcy. Why traditional method cannot be used for valuation of startup? Startup has most of the times losses. If you are having losses, cash flow method cannot be used. Earnings method cannot be used. Asset-based method cannot be used for a startup because most of the value for a startup comes from intangibles like your brand strength, or something called as software which has been developed. So a lot of things comes from an intangible factor. So it is impossible for you to value a startup on the, and even relative valuation or market approach will not work because they are normally disruptors. A startup is considered to be a disruptor. When you are a disruptor in the market, you do not have other companies with whom you can compare yourself with. What are the value drivers for a startup? What is value drivers? How does a startup derive a value? Major value will come from product or service and the execution team which is there. Apart from that, you can look at whether you have started earning revenues, how is the demand for your product, what is the industry attractiveness, how is the competition angle, what is the demand supply situation for the demand in, for the funds in this industry. Different methods for valuation of startup. Berker's approach, which is based on 5 different factors. The 5 different factors are basic value, technology, execution, strategic relationship, and production and consequent sales. Arrive at a value for each of this. If you are a pre-revenue, 2 million is the cap. If you are a post-revenue, 2.5 million is the cap. Cost to duplicate is all costs incurred to develop the startup and the product development. Add up all the cost and arrive at the value of the startup. Comparable transactions, arriving at the value of the entity based on the value of a comparable company or comparable transaction which has happened in the past. Scorecard valuation is comparing the startup with someone in the industry or the average of the industry and assigning a score on every parameter. You could be assigning a score of 100%, which means you are normal, more than 100% is above average, less than 100% is below average, and arrive at a weighted average score. First Chicago method is arriving at 3 values. One is best case, normal case, and worst case, and then doing a weighted average of that. Venture capital method is arriving at the exit value and then discounting it to today's value. Next, valuation of a digital platform. Digital platform is one which is trying to connect people and ensure a transaction happens. It could be a marketplace, it could be a search engine. Income approach can be used or cash flow based approach, where what you need to do is you will have to arrive at the income through either a top down approach or a bottom up approach. Then based on income, get the cash flow, FCFF or FCFE, and do discounting. Other approaches, market based approach or relative company valuation, or you go through a cost to duplicate approach. Special consideration for professional or consultancy firm. Again, do the valuation in the normal manner. The only special consideration is KPIs needs to be considered because KPIs basically will derive whether will help us in understanding whether the startup is doing, whether the professional firm is doing well or not in the marketplace, whether doing well or not in the industry. So key performance indicator will help us in understanding the success or failure of this entity. So if you are having a good KPI performance, your value will go up. Bad KPI performance, value will go down. Impact of ESG in valuation, environmental, social, and governance framework, a growing framework which is being followed by most of the bigger corporates. This will ensure that there is a sustainable value which is getting created. ESG basically says that if you are ESG compliant, you can get lower interest rates, better funding in the market, and also this impacts your cash flows or the discount rates. We normally will adjust the cash flows when we are doing the valuation. With this chapter is over.